Hello, I'm Alan Mendeloff, member of the Wisconsin HFMA chapter. Welcome to our video learning series on achieving the Certified Healthcare Financial Professional designation. As healthcare professionals, we work in a reform environment that requires entities to fundamentally rethink their business models. The new CHFP exam reflects this changing reality. A reform environment presents every healthcare organization with the same fundamental set of challenges: to identify new opportunities, devise creative responses, launch new solutions to achieve positive impact, and to sustain those gains. The emphasis of HFMA's certification program is developing the skills needed to participate in shaping this business environment. A critical reality is that organizations today must be learning organizations that continuously measure and understand the business environment, translate goals into actions, execute effectively, and evaluate results. Our industry needs people who can lead change in a fluid world. So the purpose of the CHFP exam has shifted toward continuous learning, not just demonstrating experience and expertise. A critical business issue is the recruitment, development, and retention of competitive talent. The new CHFP program is intended both for individuals to use in advancing their careers and for organizations to use as a component of a comprehensive talent development program. The first of two modules is called The Business of Healthcare. This module's focus is on understanding the business environment from a financial perspective. Importantly, this module includes the business realities for payers and physicians as well as hospital providers. A fundamental business assumption in building this module is that CHFPs will work in a collaborative, multidisciplinary workplace resulting from the transformation from providing care to managing health. The second module is called Operational Excellence, focusing on specific payer, physician, and provider business concerns. It utilizes case studies to present candidates to the opportunity to see real-world business solutions and to test their ability to apply the knowledge gained in the first module. This module encourages multidisciplinary thinking and appreciation of other professionals' business concerns. With these goals in mind, the chapters of Wisconsin, Connecticut, Arizona, and Vermont, New Hampshire have collaborated to bring you the following learning module. The topic to be presented is Financial Accounting Concepts. Today's speaker is Dr. Christina Bradbury, Assistant Professor of Accounting and Finance at Plymouth State University in New Hampshire. Dr. Bradbury's teaching focus is on undergraduate and graduate level business, finance, and accounting principles. Prior to her academic career, she spent over a decade at TD Bank and Bank of New Hampshire, where she was responsible for the management of a loan portfolio of more than $55 million. She prepared qualitative and interest rate stress test analyses and customer credit risk and profitability analyses. Dr. Bradbury received her master's in finance from Southern New Hampshire University and her doctorate in business administration from Anderson University. She has taught and lectured on a wide range of business and risk management topics since 2008. Additionally, she has published and presented extensively on healthcare topics from Medicare and Medicaid modernization efforts to major insurer merger impacts. She achieved her CHFP designation in 2011 and was responsible for the creation of 2 certified revenue cycle representative learning modules for HFMA in 2014. She is a member of HFMA, the Institute of Managerial Accountants, and the American Accounting Association. Dr. Bradbury.
It's a pleasure to be with you today. I'm going to be presenting on the topic of financial accounting concepts. And with that said, I want to take us away from that topic just for a second to contextualize why it's so important and why it has meaning for you. So I wonder if you remember the movie Jerry Maguire, came out about maybe 10, 15 years ago. Specifically, I wonder if you remember the famous line given by Cuba Gooding Jr., who played the NFL player Rob in that movie. He wasn't too happy about his negotiated contract that Tom Cruise, or Jerry if you will, had negotiated with the Arizona Cardinals on his behalf. They're on the phone, and he says in their heated telephone conversation, "Show me the money." Well, coming back to financial accounting concepts, that's exactly what financial statements do. And knowing financial accounting concepts can help you. They show you where the company's money is coming from, where it went, and where it is now. Financial statements are summaries of monetary data about the enterprise or the firm, whatever we're looking at. So financial accounting concepts and statements are important because they show us the money. The learning objectives I want to specifically speak to today are as follows. Talk about the basic elements of accounting, differentiate between the key financial statements and talk about what they describe, conduct a basic analysis of an organization's financial condition using financial statements. We'll talk about the practical realities and how to use financial statements, basically is what I'm saying here. And we will relate those basic measures of operational performance to the organization's financial statements. So financial statements provide for a window, right? That's what we're seeing here. They provide for a window into the financial situation of a business. As a former banker, I can tell you that financial statements provide for one of the only unbiased looks into a firm. Right? Financial statements measure the operating results of the firm's efforts as they impact revenue earned and expenses incurred, ultimately speaking to profitability. That's what an income statement is. At the same time, we use financial statements to measure the current financial status and the strength of a business. The balance sheet provides the user with data about available resources as well as the claims to those resources from both creditors and investors. Equity capital refers to the money put up and owned by the investors. Importantly, too, just like it is for you and me, it's important for the firm, it needs to make sure that it has enough cash to pay its bills. We use financial statements to gain an understanding of cash flows, how cash was made, where it was made, and most importantly, how it was spent. This is the statement of cash flows. Well, when presented in a structured manner and in a form that's easy to follow, these three financial statements provide both what's known as confirmatory and predictive power. It provides value for the user in what expectations are expected, what we can expect for the future, and understanding what has happened in the past. This makes financial statements incredibly relevant. Who's interested? Who's interested in this information in financial statements? Well, several stakeholders are interested, both inside and outside the organization. This is why financial statements are so important. So financial statements provide valuable data that is used by managers to help them assist in making good business decisions day in, day out. Right? Financial statements track operations and can provide information as to where the company's improving, staying the same, or declining so that they can concentrate their efforts in the best place which is whatever is needed. In a for-profit organization, the owners or the investors of the firm want to know how the firm's doing. Coupled with knowledge of the business plan, the market environment, and insight into the management team, financial statements can aid the investors to assess future profitability and, importantly, future cash flows. In terms of non-for-profit organizations, donors too care about financial statements. They want to know that the firm is a viable organization and a good steward of the donor's resources. Creditors or lenders, they want to know the financial condition of the company that's seeking the loan, right? They want to make sure that they're going to be paid back on that loan as well as getting the interest on that loan as per the contract. So they need to be comfortable with lending to the organization. Suppliers and customers in many settings are interested in the long-run staying power of the company. Employees are interested in making sure that the company is going to be able to deliver on long-run promises, such as pensions, as well as certainly of a viable company that will stay around so that they remain employed. Competitors, right? Competitors want to know how they stack up and perhaps are looking at the competition financial statements to identify strategic opportunities. And various federal and state agencies, governmental bodies use financial accounting information also. For those companies that are traded on the U.S. Stock Exchange, the SEC, the Securities and Exchange Commission, will monitor for adequate disclosure. Also, agencies such as the Public Health Service, Center for Medicaid and Medicare and Medicaid Services, and the Internal Revenue Service certainly care about and use financial statements. So what we're going to look at is known as the basic accounting identity, the accounting equation. And basically, on one side of the equation is assets. Those are the financial resources of a company. What's what the company has, right? It's what the organization has in order to do what it does day in, day out. On the other side of the equation, we see liabilities and equity. It's basically how the company got its resources, right? So assets, what it has, and the other side is how it got it, right? How did the company get those resources via creditor or investor monies? So let's take a closer look here at the left-hand side of the equation, the asset side. What assets are, right? They are the, as I said, economic resources of the firm. It's either otherwise said, assets either possess or create economic benefit to the business. So we're talking in terms of variety of different assets. Cash represents actual cash, right, for the firm, and that on hand and within their commercial checking accounts. Cash equivalents or cash-like investments that mature in 3 months or less, such as treasury bills, commercial paper perhaps. They're highly liquid. Net patient accounts receivable represents revenues for services provided that have not been collected. That's an important asset. Inventories provided that are on hand, primarily medical supplies. Long-term investments, we can look at long-term investments as financial assets, those investments that are less liquid than short-term treasury bills. Now we're talking about equities and long-term bonds, potentially. And property, plant, and equipment represents real assets, right? Tangible assets that the organization certainly uses and owns in order to conduct business. Look at the other side of the equation, liabilities. Liabilities represent payment obligations of the business. Okay, simply stated, that's what it is. They represent payment obligations of the business. Failure to meet these claims can certainly be detrimental to the organization and result in potential bankruptcy and closure. My examples of types of accounts you might see on the liabilities side. Notes payable. Notes payable are short-term debt obligations. Typically, these are bank loans. Accounts payable. Accounts payable stems from buying goods, such as medical supplies, for instance, and from vendors. And this is basically trade credit, where the company benefits from getting inventory but not having to pay for a short period of time. Accrued expenses, accruals, those are miscellaneous payment obligations of the business. Salaries to employees if we're between paydays, taxes to the government, authorities, interest payments on debt, so on and so forth. Mortgage debt, certainly any loans on real property, and any potential other obligations. Looking at that last category, equity. Equity for an investor-owned business is basically the value of owner-supplied financing. So for a for-profit, the equity represents the claims that the investors have on the business, right? In a not-for-profit, this is basically the value of the capital that's been supplied by the community, often labeled as net assets. So in a non-for-profit, you might see this equity labeled as net assets. So the equity account really represents a residual of what the resources of the company has and the claims against it, and what's that net worth that's left over, which is equity. The accounting system, which is used by healthcare organizations, such as physician offices, hospitals, dental clinics, health plans, to name a few, we're basically looking at what's known as double entry accounting. Right? There's two sides to every transaction, like there was two sides to what we just looked at, the basic accounting equation, right? And that those two sides must always be equal, both in terms of the transaction as well as in total. So let's take a look at some examples here so that you see how this works in practice. Number one, we're talking about a transaction as simple as if a healthcare organization borrowed $4,000 from a bank, First American Bank. What does that mean in terms of what happened for the company? Well, the company gained assets, or specifically cash of $4,000, so the asset side of the balance sheet goes up, but so does the liabilities, the claims against those resources, right? The bank, there's a loan out there that must be repaid. So notes payable is one of the accounts that we'd see under liabilities. That account goes up too. Again, in balance. Purchased equipment for $15,000 in cash. Here's an example of a double entry accounting entry that occurs only on one side. The net effect to liabilities and equity is zero. So if the company purchases equipment and they use cash in order to purchase that equipment, and we're talking about equipment valued at $15,000, well, that equipment value will go up $15,000 and cash will go down $15,000, the net effect again being zero on both the asset side and the other side of the balance sheet, liabilities and equity. Another example here, what if the organization purchased medical supplies of $200 and equipment of $1,000 on quote-unquote account? So they did not use cash to do it, but rather they used accounts payable, vendor credit, trade credit. The company benefits, the organization that is, benefits from additional supplies worth $200, equipment worth $1,000, so assets go up $1,200 in total. $1,000 in total, $800, $1,000 in total. And the other side, accounts payable, also goes up $1,000. So once again, we're in balance. The net effect of all three of these transactions results in assets going up by $5,000 and liabilities also, the other side of the balance sheet, the other side of the accounting equation going up $5,000. So again, double entry accounting is very important. We're always talking about everything staying in balance here, and this is one way to make sure that a bookkeeper, if you will, is put in the transaction appropriately accordingly. Coming back to these financial statements here, we've talked through the basic accounting equation, and basically what we've talked through is the balance sheet. That's what's known as the balance sheet. That's the title for it. I've mentioned that already. So if we're talking about a for-profit, we call it a balance sheet. In a situation where we're talking about a non-for-profit entity, we call it the statement of financial position. And basically that summarizes the organization's assets, liabilities, and equity position, as we've talked about. It's a snapshot, right? It's really a snapshot of what the organization's got and how they got it. And it's important to note that that balance sheet, or that statement of financial condition, if you will, is kind of like taking a picture, right? It's taking a snapshot as of a specific date. The organization's position changes from day to day to day. So we're looking at what the organization's got and how they got it as of a specific date. The income statement, we haven't talked about that one yet, but certainly there'll be some familiar items here. We're talking about, what the organization's been doing over the last, say, year, right? What have they generated in the way of revenues, and what expenses were incurred in order to generate those revenues? And in a non-for-profit situation, we typically call that income statement a statement of operations. It does directly tie to the balance sheet. We'll talk about that later. There is a relationship between the two. But the income statement is showing for a period of time, whereas the balance sheet is showing as a point in time. Finally, the statement of cash flows, which is the same terminology if we're talking for-profit or non-profit. It summarizes how cash was used and where it was obtained. So let's talk about these a bit further, one by one. Again, the balance sheet, here we are, looking at assets on one side, liabilities and owner's equity on the other. This is, again, what the organization has and how they got it. Here's a sample of the balance sheet. If we take these, we could show it both horizontally with assets on one side, liabilities and equity on the other, or we could show it vertically. What's important is that we have balance, right? We have that equation always in balance. The income statement, as I've mentioned, provides information about the revenues and expenses of the business. What has the organization been up to over the last year, right? What type of business, how much business have they generated, and what were the expenses in order to meet that business. What's left at the bottom, known as profitability, profits or potentially a bottom line loss, can be known as net income or net loss. Importantly, hospitals and physicians that serve patients, we need to talk about some different line items here under the revenue section specific to healthcare. Again, those organizations might have something known as bad debt or charity care. Healthcare providers, certainly have to treat patients that may or may not have the ability to pay. So there's an important differentiation between patients that are unable to pay and patients that are unwilling to pay. Many consider them the same, but they're not the same. That's not a correct view. The difference is that bad debt, there's patients that have the ability to pay, right, to pay for the service rendered, right? The physician has treated them, they've been treated by a nurse, and they therefore need to pay on those services, but they don't pay. That's bad debt, right? And it wasn't collected. Whereas charity care deals with some organizations provide to patients that are unable to pay without the means to pay for their care. That's charity care. Some other important points here under revenues is that there are other operating revenues that may be outside the patient care side of things, right? We have certainly that represents the bulk of revenues, but we might also have some ancillary revenue sources such as cafeteria sales, parking garage receipts. Those certainly would be considered as revenue also for a healthcare organization, but those would be classified as non-operating, as operating revenue, but they would be not found under patient service revenue. Some expenses, right, to support those revenues generated include the likes of salaries and benefits, right? Salaries and benefits expense tends to be typically the largest expense for a healthcare organization. Supplies expense, the cost of medical supplies, medical materials could also be a large expense. Insurance expense represents the cost of commercial insurance purchased to protect the clinic against risks, against property, both risks of property or malpractice. So giving you a flavor for the types of revenues, right, both patient service revenues and the possibility that not all of those revenues will be collected and those will be netted out of gross revenues, either as bad debt or charity care. And then we've also talked about some other operating revenues from ancillary service sources. And we've also talked about some of the large expenses for most healthcare organizations, such as salaries and wages, insurance, and potentially supplies. Relationships between the balance sheet and the income statement. It's important that you understand that there's some very close interrelationships between the two. Most importantly, I would say, is the relationship between receivables on the balance sheet, right? Patient receivables, and revenues, which would be found on the income statement. So, in many cases, a healthcare provider, physician or hospital, provides services on any given day, but they have to wait for the payment, right? They're not paid up front. They're not paid on the day that the service is rendered, but rather they may wait on average a period of somewhere between 40 and 60 days. So it's quite a lag time in order to collect on those revenues which have been earned on the part of the healthcare organization. So certainly it's owed to the organization, right? They've earned it, but they haven't received it. So it'll be booked as a receivable, a patient receivable on the balance sheet. It's an asset until that receivable is collected, that IOU, if you will, is collected and converted into cash. So there's a relationship, as I said, between the two, the balance sheet and the income statements, these two financial statements that are very important because a large portion of those revenues represent patient service revenues, right? This is healthcare organizations are in the business of delivering a service, right? And not paid on the day the service is rendered, therefore that will be reflected as a receivable on the balance sheet, and that impacts the balance sheet, and when it's collected we'll receive cash. So that timing, which is really captured in something known as the revenue cycle, is very important, and a very important issue for the healthcare organization, certainly today, to make sure that they're managing good receivables, that they're carrying good receivables, and that they're managing a revenue cycle that can work for them. The third statement, the statement of cash flows, right? The statement of cash flows summarizing how the organization got their cash, where it was used, and how it was obtained. Basically is designed to answer three questions, as you can see here, which I've talked somewhat to, right? Where did the business get its cash? What did it do with the cash? And how did the cash position change? How did the cash position change? Statement of cash flows is going to break down activities, break down the going-ons within the organization, those different accounts, by looking at things in terms of three activities, I should say. Looking at operating activities basically represents the day-to-day of the organization. The operating activities section could say is the most important of the three buckets. Operating activities deals with revenues and expenses of the organization, what the company's been doing day in, day out, normal course of business, and certainly generating revenues, collecting on those receivables, increases cash for operating activities, or paying out for expenses incurred to generate those revenues, such as salaries, utilities, taxes, as you see on the screen, would decrease operating activities, decrease cash in that area. Investing activities is important, deals with basically the stuff of the organization, the long-term assets of the organization that are important in order to do the business that they do. Investing activities, cash, a source of cash in this area would be the sale of long-term assets, property, plant, and equipment, and a use of cash would be purchasing, right? Expansion, and therefore building or purchasing buildings and land. Financing activities, the last bucket, which I have dubbed borrowing and begging. This financing activities deals with long-term debt and equity types of activities. So whenever the company is borrowing money, certainly that's a source of cash, or if they're paying off their loan, that's a use of cash in this area. Also, perhaps in a for-profit, whether there's an owner that's injecting money into the business or taking money out in the form of a distribution, would be found in this bucket as well. So cash flows show where the money was obtained and where it went, and is broken down into these three buckets of operating, investing, and financing activities to help provide some order to the statement of cash flows, where again the operating section tends to be, I'd assert, the most important of the three areas because it speaks to the day-to-day operations of the business. I'm going to talk about these turn away here from the financial statements and talk about some accounting methods. There's three accepted accounting methods. In the accrual accounting method, next screen here we go. In the accrual accounting method, this is uses the matching concept. Revenue is recorded when it is earned, and expenses are recorded as they're incurred. So revenue is charged to the balance sheet. We're showing that the organization has earned it, regardless of whether or not cash has actually been received. So under the accrual accounting method, you would see receivables, you would see payables. You would not see those types of accounts under, say, a cash basis accounting, which I'll get to next. So accrual basis is a bit more complicated by that, but it's also truer because it's reflecting the fact that the company has earned it. Right? Revenues are recorded as they're earned, as you see here, well said on the screen, not necessarily when cash is received. And expenses are also shown to at that same point in time as when they are necessary, they've been incurred in order to support those revenues. So the accrual accounting method is important in that it underlies something known as GAAP, or Generally Accepted Accounting Principles, as defined by the American Institute of Certified Public Accountants. So healthcare organizations that need to provide for reviewed or audited quality financial statements per their, say, creditor, right? They need a loan. The bank might require that they have a certain quality of financial statements, and likely what they're going to ask for are financial statements that conform with something called GAAP. And basically that means in terms of what we're talking about here, that they're talking about accrual-based accounting, the accrual-based accounting method. So in that regard, we see that many and most healthcare organizations therefore do provide for financial statements that are in compliance with GAAP and thereof accrual accounting methods. The cash basis accounting is far more simplistic, it's far more easy. Revenue is recorded when cash is received. Right? It's basically how we keep our checkbook, if you will. And we would record revenue received, we deposit it into the bank, and we record expenses as we make those payments. In terms of the healthcare organization, coming back to the company, some examples of using cash basis accounting, you might see that in terms of some of the ancillary departments in the organization, such as the cafeteria, the gift shop, medical record release of information. They might use cash basis accounting, and that might make some sense for those folks, for those areas. So to recap, accrual versus cash basis. Cash accounting recognizes an event when the cash transaction takes place, really simplistic, like the way that we manage our checkbook per se, right? Accrual-based accounting, however, uses the matching concept and basically recognizes revenues when earned. So when the service is rendered, when the patient is seen, right, the organization has earned those revenues and therefore books the receivable and waits for the cash to certainly come. And the accrual accounting method is what is required of what's known as GAAP. Finally, want to talk about one more accounting method here, which is used by non-for-profits, called fund accounting. It's a record-keeping and control method used to manage the categories of net assets to ensure compliance with the restrictions on those funds. Might see the likes of different types of accounts as unrestricted, temporarily, or permanently restricted. So if donors provide for monies that are to be used in only certain ways, or if grants are received by the healthcare organization, in a non-for-profit certainly context, they can only be used on certain programs, then we would see the presence of fund accounting, which must be used to show that these monies are being used for their intended purpose. So recapping here, coming back to it, financial statements provide for a window into the business. Right? They talk about operating performance. They show us economic resources. They show us that the company has. They show us what the claims against those resources are, where the cash was generated, where it was spent. That's valuable information. And as I said earlier, this this window into the business is one of the only unbiased windows that we have. So financial statements provide for that look into what the company has, what their financial strength is, and certainly speak to what they've been doing and how operating performance and how good management's been able to work with that organization over the last period. So now I want to turn from the relevancy of financial statements. Now we've established that it's important and accounting statements, concepts are important. Let's talk about the practical use of financial statements. An item on the financial statement has very little meaning by itself. The meaning of the numbers can be enhanced by drawing comparisons. So it's very nice and good intended, and it's great that we have financial statements. Users care about this information. We've been there, done that. We understand that. But how do we use it, right? In a practical way. How do we use financial statements to make decisions? So financial statement analysis is that practical relevance, that practical application that I speak of. So ratios help us compare the performance of different organizations that are of different size. Right? So for example, it's very difficult to compare two healthcare organizations if we're just looking at their absolute numbers. But rather, if we provide for ratios, we put them on an even playing field so that we can now compare apples with apples. So comparing financial ratios over a period of time as well as against that of a competitor or that of the industry can be very insightful, so that a healthcare organization can see as to how they're trending and how they stack up in general against that of the marketplace. Ratios can be used to identify companies and organizations' strengths and weaknesses and can provide useful insights into basically the overall financial health. So we're going to take a look at, and there are several different financial ratios that are out there to help us look at different dimensions of the business. We're going to touch on a few today. Let's take a look. So recapping some of what I've said, we're talking about ratios. Ratios are very helpful. You can compare what has happened within the business, the organization, to that of previous years, some target, competitor, the industry. And I think you might appreciate a medical metaphor here. We can basically categorize an organization as being ill, healthy, or fit. But what matters most is that we understand where on that spectrum, where on that continuum the organization lies in terms of its financial health. And we're going to look at three major ratio classifications to help us expose the firm's condition. Profitability. Do revenues exceed overall costs? Are revenues high enough? Liquidity. Can the organization make its required payments as they come due? Debt management or capital structure, right? Talking about the mix of debt versus that of equity. So the first classification we're going to look at is profitability, and it can reveal and speak the difficulty of the firm's ability to cover its costs. More formally, profitability ratios measure the overall impact of operating decisions on a business's financial condition. Because businesses need profits in order to remain viable, in the long run, profitability ratios might be one of the, if not the most important group of ratios. So, as I said, we're not going to look at all types of ratios here, but here's a nice sampling, some important ratios that you might see that you should be aware of, some terminology to help us get a look, right, to dig into the organization and look at its profitability. So let's look at operating and net profit margin first. Operating margin speaks to the operating profitability of the organization, right? We're talking about operating revenues. Those revenues have been generated from its core normal course of business, right? Seeing patients. And operating profitability as a percentage of overall revenues. So for example, an operating margin of 2% means that for each dollar of revenue generated, 2 cents on every dollar made its way to bottom line or operating profits. This ratio is similar to the net profit margin ratio that follows. The net profit margin ratio speaks to bottom line profitability. So bottom line profitability, not just operating profitability. We could have revenues or expenses that are from non-operating sources, which would be the difference here. All profitability ratios must require some context. So we're going to look at operating net profit margin in context of how do these margins compare to the prior years, and how do they compare to the industry or the competitors in general. Typically higher is better, but again, that context is important. Some other ratios, some ratios that are important to MCOs: medical loss and administrative load. The medical loss ratio measures the percentage of premium revenue devoted to medical care. The greater the ratio, the lower the profitability of the organization. But however, if the ratio is too large, the organization might face financial distress. So having a greater ratio, may have the organization facing some financial issues. On the other hand, if it's too small, the organization may not be providing all the healthcare services they should be to the covered population. So there's a fine line, there's a balance. We can't look at margin ratios and say with absolute certainty good and bad or bad. We've got to contextualize it, right? We got to use it to help us understand and ask good questions. Administrative load, or administrative cost ratios, it might be called, measures the percentage of premium revenue devoted to administrative expenses. All else the same, the higher the ratio, the greater the ratio, the greater the profitability. But if this ratio is too large, the organization may not be providing sufficient care. On the other hand, if it's too small, the organization may not be providing sufficient administrative support to the covered populations. So that's one dimension of looking at an organization's financial strength. Let's talk about another, liquidity. Liquidity speaks to whether the organization is able to meet its short-term debt obligations as they come due. Right? That's certainly important to make sure that the company's got cash on hand, protective liquidity, in order to remain viable. Failure to meet one's obligations as they come due can be detrimental, as you certainly know. So some ratios that we're going to look at here, again, not an all-inclusive list. Importantly and commonly, the current ratio measures the dollars of current assets per dollars of current liabilities. So current assets include the likes of cash, receivables, inventory, if you will, medical inventory, whereas current liabilities include those obligations that are coming due within the coming year. So making sure that there's a buffer there, right? That there's enough current assets to cover those liabilities as they come due. So a current ratio of 2.5 times would indicate that there's 2.5 times the level of cash, receivables, and inventory, if you will, to cover those short-term 12-month obligations that are coming due. That provides for some buffer. The higher the better in terms of the creditor, but certainly, again, we can't look at these as entirely a good or bad, because a high liquidity ratio, a high current ratio, could mean that the company's not using their resources in the best possible manner, most efficient manner, right? They're not using them in a way to get a greater return. So tying one's money up in their checking account certainly isn't the highest and best use when they could be putting them to more productive use, is what I'm saying. So again, there's a fine line between what should be the current ratio, what kind of buffer we should be looking at. Days in cash, or days cash on hand, measures the number of days that the organization can continue to pay its average daily cash obligations without any new cash resources becoming available. That's pretty telling. Higher values implying higher liquidity, and hence are viewed by more favorably from the likes of creditors. Net days in accounts receivable measures the average time that it takes an organization to collect on those receivables, right? So the shorter the collection time typically is viewed as better, right? We want to get paid on cash as quickly as possible. Certainly it helps us on a personal basis to have cash rather than having to wait for it. So net days in accounts receivable gives an organization an understanding of how long that the organization is waiting to collect on the receivables. And the shorter the collection time, the quicker that receivable is converting into cash. Days and payables. Days and payables is basically the counterpart, if you will, of net days and accounts receivable. This is for the benefit of the organization. It speaks to how much time does the organization have before it has to pay its bill to its vendor, right? So the organization may benefit from receiving medical supplies up front and having some time before it has to pay that bill for that inventory, for those supplies. That's known as a payable. So a stretching of payables is viewed positively. A higher days in payables is viewed favorably because it means that the organization benefits from having some time before it has to pay on that bill. Capital structure, the last of the three ratio groups we're talking about here. This is important. It assesses the amount of debt financing that was used by the business, right? This speaks to financial leverage, right? How much debt has the organization used in order to acquire its resources? So there's, unlike for you and me, for an organization, there's advantages to having debt, right? It can be advantageous because Uncle Sam provides for a benefit in terms of taxation, in that interest expense is deducted before the organization is taxed on its profits. So in that regard, interest expense makes the cost of debt less expensive than it already is. And that's advantageous. It can also serve to boost one's overall return. But again, having that monkey on your back, so to speak, having that obligation always that's coming due at regular intervals, making sure that one is able to and has to meet that obligation certainly comes with risk as well. So some meaningful measures, again, not an all-inclusive list. We could look at both debt to equity, which is a capitalization ratio. It measures the amount of dollars of debt financing per dollar of equity financing. So for example, if we have a debt to equity ratio of 0.6, that indicates that creditors have supplied 60 cents for every dollar that's been supplied by investors or donors. Debt service coverage. Debt service coverage is a coverage ratio. It's very important. It speaks to the number of dollars of cash flow that's available to make debt payments. So certainly it's similar, somewhat similar to what's known as the times interest earned ratio, but it recognizes cash flow rather than accounting income per se. And basically the debt service coverage ratio, higher the better, provides for some buffer in making sure that there's enough money to pay the debt as those obligations come due. So we can break down the question of financial health into these three categories of profitability, liquidity, and capital structure, right? And interested parties care about these different categories and wrapping their arms around basically the organization's financial health. Right? They want to make sure that they are, from the management's point of view, that they're effective, right? That they're doing the best job that they can, that they're keeping their shareholders happy, they're keeping their donors happy, and certainly they remain viable. The creditor, the investors care because certainly they want to make sure they're going to get paid back, that they're earning a fair return. So understanding the financial health of the organization can be accomplished by using financial statements, but to make them usable, to make this all very practical, to really wrap our arms around it, we use ratio analysis to help us understand those different dimensions. And we compare ratios over a number of years, as well as looking outside the organization itself and looking at how it compares to that of others, to figure out where it lies on this continuum of financial health. It's important to point out as well, I'd be remiss if I didn't mention that there's some limitations of financial statements, right? I mean, financial statement analysis is incredibly useful, but financial statements this analysis has limitations. And really, at the end of the day, in many ways, it provides for good questions and provides for, generalizations as opposed to absolute truths or absolute specific detailed answers. So some limitations of financial statements I just want to make sure that you're aware of. Maybe that it's difficult to find a meaningful set of industry averages, right? When we're talking about large firms, many large healthcare organizations operate in very different divisions, different industries. It's very difficult for those companies, those organizations, to find a meaningful set of industry averages of a like competitor. Financial statements are not exact. Now, that might come to somewhat of a shock to you, right? Financial statements in many ways involve a lot of judgment on the accountant's part. So it's outside the scope of this presentation, but if we look at different assets such as inventory, medical supplies, if we look at receivables and how to account for bad debt, and a variety of other types of accounts, we'll find that many of them are a matter of judgment. So judgment and estimation is a very important component of accounting. So financial statements are not an exactitude per se. Ratio analysis is backward looking, right? We're looking at what has happened, not necessarily what's going to happen. Now, it's certainly useful to have an idea as to how the organization is done historically, because we might assume that the organization will continue to be viable if it always has been, but there can be some very important factors that may affect the organization's future, such as the health and certainly making sure that senior management stays in place, right? That the CEO is still there. That we need to look at the marketplace. Has anything changed? Has there been new entry into the healthcare market? Certainly, those types of things could certainly be influence the future that we wouldn't see in the historical looking financial statements. Different accounting practices can distort comparisons. I spoke to the fact that there are different ways to provide for valuations. So trying to provide an apples to apples sometimes can be difficult if we're looking at different accounting practices. So the notes to the financial statements which speak to those practices would be useful. And again, it's important that we acknowledge that we can't necessarily look at ratios as entirely just good or bad, black and white, right? And making generalizations can be very dangerous. So conducting ratio analysis is useful when we're talking about it being used used intelligently and provide for some insights, to ask good questions, to get our hands around things. But we can't conduct ratio analysis in a mechanical, unthinking way. So we've talked about today the relevance of financial statements, the practical use, and some limitations I've pointed out thereof as well. I hope that you found this useful. It's been my pleasure. If you have any questions on the material that I've presented to you today, by all means, feel free to contact me. My contact information is here, cjbradbury@plymouth.edu. Emailing me is the best route. I wish you all the best.